super, super excited about this book. A little bit of my story, right? So I lost everything in the public markets. This is where all the normal investors play, right? This is the playground of the normal investors. They do 60-40 portfolios. And if you have a financial advisor, you're in 60-40 portfolios. You know me in it? No, you're in a 60-40 portfolio, but you are. Maybe you're in 70-30, but it's a 60-40 portfolio. And it's dressed up, but that's what it is. They're just so darn flawed. I mean, there's incredibly volatile. You don't have diversification. Even if you think you buy the S&P 500, you're getting 500 stocks. A third of the S&P 500 is 10 companies, which all move together anyhow. You ever notice when the screen goes red, everything goes red? There's no diversification anymore. I can explain why, but there isn't. Well, number one, they have 50 to 60% of their assets in private alternatives and 20 to 30% in the public markets. 20 to 30. That is the biggest difference because people are trading baskets. And so therefore the basket moves in synchronization. And that's exactly why the speed of the internet and information moves. And everybody has to lots of information at the same time. That necessarily didn't happen in the 50s or the 60s. So there's a lot of reasons. JP Morgan gave an analysis of why the correlations are so high, but they just are. And the only way to get truly uncorrelated assets is to go private. And they are not correlated to the public markets. They're highly uncorrelated. You think of it as an investment business. I'm going to spend time. I'm going to learn. I'm going to go to conferences. I'm going to read books. I'm going to become a fantastic investor. People think it's unattainable. It's beyond them. It is not. Just like everything we've learned, we learned. And so you can be a great investor. That's my encouragement, is become the CEO of your money. And that's one of the biggest differences, that the family offices, the pension funds, these guys, they have a business called investing, and they spend a lot of time and effort to do that.
One of my favorite questions is, how are you going to lose my money? Where are the risks and what needs to go wrong for me to lose my principal? Not how great are the returns or what's my preferred return or what's my split, but how am I going to lose money?
Talking about risk, and no one wants to do that, right? But it's more important not to lose money than to make money.